Thank you, and good evening, everyone, and welcome to the 521st meeting of the Economic Club. And as you notice, we are trying a new formula. We have our breakfast and our lunches, but we've now trying this new formula of evening receptions, and I thank you all for being here. I'm Marie-Josée Kravis. I'm the chairman of the club and a senior fellow at the Hudson Institute. And as you know, the Economic Club of New York is really the nation's foremost platform for discussing social, political, and economic issues. And tonight, I'm sure, will not be a disappointment. I want to thank and recognize the 306 members of the Centennial Committee, many of whom are here, and you are really the financial bedrock of this organization, and it's thanks to you that we're able to have these very diverse and stimulating programs. I'd also like to welcome the 2020 class of fellows. Excuse me, I was happy to meet with you before this event, but I welcome you to probably your first event at the Economic Club of New York, and I hope that you'll be attending as many events as possible. The Fellows is really a program that we started 4 years ago to bring in the future generation of thought leaders in our business and financial community. So I welcome all of you and wish you great pleasure and success in this endeavor. It's my pleasure now to introduce our special guest this evening, Lee Ainslie III, who is the managing partner of Maverick Capital, which is, or has long been known, I think Lee said 26 years since the founding of Maverick Capital. It's long been known as one of the largest and most consistently successful hedge funds. Before founding Maverick in 1993, Lee was the managing director of Tiger Management. He currently serves on the board of the Robin Hood Foundation, where I had the pleasure of serving with him, the New York Presbyterian Hospital, the Episcopal High School in Alexandria, Virginia, and he's on the executive committee of the Partnership for New York City. Lee received a BS in Systems Engineering from the University of Virginia and an MBA from the University of North Carolina. The format tonight is a conversation, and we're very fortunate to have a member of the Economic Club's board, Mark Gallogly, who also is the managing partner for Centerbridge Partners, doing the honors. So thank you, Mark. We've shared with Mark some questions that were submitted by members, and so he will try to incorporate those in his discussion with Lee Ainslie. I want to remind you that the conversation is on the record and it's being carried live, so if you could please turn off your phones. And now if I can invite Lee and Mark to join us on the podium.
Thank you, Marie-Josée. It's a great pleasure to be here. You know, on Wall Street, there are a lot of successful people, but there are very few people who are as well thought of as Lee. I mean, he just has a lot of friends. And the reason for that, I think, is not just the returns he's given to LPs, but the way he conducts himself in business. So it's really fun to have a chance to speak to him and learn a little bit more about him. Lee, give us the pitch on Maverick.
First of all, thank you for those kind words. And before addressing that question, maybe just to balance out a little dose of reality, just to give some insight into my life. Sad but true story. 18 years ago, my then 6-year-old son, who's now sitting in the front row, was playing with his little 3-year-old brother in my office one Saturday morning. I asked him if he could take his little brother to a different room. And he said, "Dad, I can't control him. I'm not his wife." Sad but true. So the pitch on Maverick. We're in 4 different businesses, but the business I think we're best known for, and certainly where the majority of our resources are focused, is the fundamental long short business. And I think over time we've done a good job of recognizing what parts of our mission have to be consistent, such that the investment team, our investors, understanding what we're trying to achieve year in, year out, and yet also recognizing that if we're static in this very, very competitive business, we're going to get left behind. And so it's really led to a mentality from the beginning of trying to find ways to improve our ability to achieve those objectives.
So what's the newest thing? What's the newest thing you've had to do to improve what you're doing?
I'll step back a little further, then get to newest. I think what's ended up being one of the most significant decisions we made was back in 2006 to launch a quantitative research effort, which at that point in time, I'm not aware of any other fundamental fund that had thought about doing that. But I'd gotten to know and be friends with some of the leaders of the major quant firms, and I have a degree in engineering, as I mentioned, and started recognizing there was the potential that we could improve the efficacy, the accuracy, the objectivity of fundamental decisions with techniques that were common in the quantitative world. You fast forward today, in our fundamental business, virtually every piece of an investment process is informed by quant, whether it's giving great ideas to our fundamental teams to go track down that screen as something that should work quite well, improving the accuracy of our modeling. There's a tool that informs us on position sizing, which we've been using since 2012, which has proven to be very efficacious. How we think about risk today is far more sophisticated and far more comprehensive than anything we could have done a decade ago. So, in that fundamental decision process, humans are still making all the decisions, but the tools we have that are available to us hopefully help us make better decisions. And then the last big decision, which I think is proving, or I think we're sure in the beginning of this, but you can see where this is going, is can we generate meaningful data from the world of alternative data or big data that helps us make more informed decisions. And taking that mindset as a fundamental investor that wants to know everything about a public company that any other investor could know. We have a very focused research effort, typically less than 3 investments per professional. We're asking the same questions we've always asked, but now doing so in ways that, again, are more sophisticated, that are more reliable, that allow us to statistically test how valuable that information could be. And so that push into alternative data, I think, is the latest thing that's going to have a very meaningful impact over time.
For the last third of this conversation, we'll open it up to the floor. Someone out there must be a data person. Maybe there are many of you who are data people. Test this comment, okay? So Lee just told us that he's changed his process based upon the information that he's been able to glean, he and his team, over the last, sounds like 14 years from data. So some of you are going to be better at that than I am, okay? So that's going to be one thing I'm going to ask you to participate in this conversation. Let's say that you look at the nature of risk today and the utilization of data. In the market in which you exist, we all exist, so much passive money has come in which focus, as you've pointed out before, is around market capitalization as opposed to fundamentally driven data analysis. So how do you operate in that world? How does that impact your world?
So I think in the short term, it makes life more challenging, as a greater proportion of invested capital is responding to one rather simplistic metric, relative market cap, and really not attuned and doesn't care about quality of the management, the growth rates, return on capital, quality of the business, competitive dynamics, just not relevant to that pool of capital. And it's challenging in the short term because fundamental changes often do not get reflected the way they used to in stock prices. However, as that persists over time, and you have a growing disconnect between the true value of business and how the stock market is valuing the business, that creates great opportunities for fundamental investors. And so it's our job to recognize those disconnects. Another way of thinking about it is I would far rather compete against, again, a pool of capital that's being driven by one metric than a pool of capital driven by investors who are looking at the exact same fundamentals that we're looking at. So again, over time, I think it's a healthy dynamic, but you certainly don't see that day.
In the short term, if you know that the market on the passive side, which is massive relative to the hedge fund side, is overly focused on market capitalization, and if you've got a data capability that you can do whatever you want to do with, are you using that information to try to understand what you expect the market to do, and then adjusting your fundamental analysis because of that new information?
But I should say in general, in the core hedge funds, we've worked really hard over time to have returns that aren't very correlated
Right.
to the market. We spend some time thinking about different market dynamics, but we don't move net and gross exposure very proactively. And frankly, when we do, it's far more likely to be driven by our impression of the relative attractiveness of our longs and shorts. So I know one large macro fund that has a group of 20-some people, and all they do is track flows for market insights. So we have not taken that
And what do you
approach.
think, your decision not to do that versus another firm's decision to invest behind that, what does that tell us about your perspective on how you think about risk and opportunity?
I'll come back to that. I think what it really goes back to is when I first left Tiger and decided to start Maverick, I spent a lot of time trying to self-evaluate where I had a lot of confidence in my abilities and where I didn't.
Right.
And I was very confident that I was a good stock picker. I had no confidence that I was a good market timer. And so we constructed, which is still in place today, this concept, a little higher gross than most people have, a little lower net, a much lower long-short ratio, looking at, back then we were doing by industries and by regions. Today we do it by factors. And we can get it wrong, but again, typically how the market's performing does not play a big role. So much more of our time is invested thinking about the quality of the individual positions and other potential investment opportunities. And even, I think it's another thing that we've done successfully over time, even for individual positions, we're spending a lot of time trying to understand what that risk profile looks like. And so we're not only thinking about, gee, where do I think this stock could be in 2 or 3 years, and what a great investment that is going to be, but thinking about that in contrast to what all the potential downsides are, and thinking about that trade-off.
When you left Tiger, that was 26 years ago, you've been consistently performing really well through ups and downs. This market today, if you look at your direct competitors, many of the hedge funds are being run by people who haven't been through those wars or that 25, 26-year period of time. The lesson of the last 10 years has to be buy the dip. I mean, so how do you compete with that? How do you think about that? And what does that mean for either the market or for the industry of hedge funds?
And just to be clear, we've had a few years we're not proud of as well. So
Yeah.
I think all in all, we've done just fine, but it's not always been perfect. One of the things we've been talking about with our investors, which I think is quite disappointing, the HFRI Long-Short Equity Hedge Index is the most comprehensive index of different long-short funds. Back in 1998, its trailing correlation for trailing 3 years with the S&P and the Morgan Stanley World Index was 29%. At the end of 2019, it hit an all-time high of 89%. That's not an uncorrelated return stream. And I think to your lesson, to your point, that largely has been driven by investors recognizing, hey, this is a one-way market and I need to get on board. If you look at some of the factors that we track 20 different factors. Some are very common, some we've constructed ourselves. Growth, beta, low capital expenditures, and high hedge fund ownership were among the very best performing factors. So people were gravitating towards the same sort of stocks. And in last year's risk-on world, especially towards the end of the year, you can see why those factors performed well. What I find more shocking is to look at what did not do well. Cheap stocks, whether you measure it by price of sales or cash flow yields. Stocks that had strong earning revisions. Underperformed stocks with weak earning revisions. First time since 2009. And then finally, stocks with high returns on capital, underperformed stocks with low returns on capital. So it was a really strange market environment, and I think part of that explains why so many traditional quants had a difficult year, because the factors that are highly correlated with long-term success of a stock weren't working last year.
Okay. That whole relationship that you just described sometimes reminds people of other periods where there's been a real breakdown in the correlation between what historically has worked and what's working or not working today. In your most recent letter, you talked a little bit about 1999 compared to today. Describe that a little bit for us.
So I think there are a number of parallels. One, those factor biases were quite similar in 99. The focus on growth versus value is at an extreme. You can measure a lot of different ways, but almost any way you measure it, you'll find there's never been an extreme like this other than 99. And I'll give you one last one. It's just look at, over the last 25 years, if you look at the 5 largest stocks in the S&P, over time, they've averaged a total of 13% of the S&P's market value and a total of 13% of the S&P's net income. Well, last year, once again, they were 13% of net income, but 18% of the market value. That's the most extreme delta since 1999, where you have these large companies really driving the market more so than driving income or cash flow.
The 5 today are viewed as taking excess rent because they're more or less monopoly providers, right? With the 5, is that true of the 1999 top 5 as well?
You know, I did not go back to look at what the top 5 were, but I'm going to guess that is less true, just because they weren't businesses back there that had the network effects of the businesses today that allow that near monopoly type
That
structure.
whole structure of today's market, top plays, and the 18%, I think you just said 18% for the top 5, those particular companies, if you rip apart their business and look, or their numbers, and try to assess their cash flow multiples or their PE multiples or their multiple of book value, how do you see that for those types of companies?
So I think clearly today's investor, which, thank you, Fed, this is the whole idea, right?
Yes.
Drive us to risk assets. To pay the valuations they're paying, you have to assume that there will be a better margin structure in the future for virtually every one of those businesses.
Or they'll keep the margin structure they currently have.
In that case, it's hard to find a discount rate that defends the valuation.
Huh.
So you have to make some assumptions. Is it going to be 5 years, 10 years, 15 years, and how do I discount that?
It gets better.
If you can make some assumptions that, to your point, may or may not play out.
So let's take Alphabet. Alphabet today announced broke down its cloud business and its YouTube business, and it's pretty clear it's making a fortune in certain businesses, and therefore it must be losing money in other businesses. So if you disaggregate that and just look at that business, does that business need to improve? Either Alphabet or any other of the bigger companies needs to improve their margin in order to be stocks that you would want to own today, or do they have to just keep it for a long period?
It's the trade-off of how do I build that monopoly position? How do I continue to take massive share?
Right.
But at some point in time, what's the point if you don't monetize it? In other words, what's the point if you don't start to take better margins?
Jim Rogers was a professor of mine at Columbia. He always said, just make sure you understand book value, okay, multiple of book. And today's multiple of book for the top 5, even though the PE may not be out of whack, the multiple of book is mega for the reason that you point out. Do you see a regulatory shift coming? Do you think that it's likely that no matter which party is in power, they're going to allow the top 5 companies to be monopoly providers? Or do you think that it's likely over some period of time that they don't get to keep that position? Because if they don't, that's the thing that's allowing them to have massive multiples of book value, because they have massive earning power. What do you think of that?
So you certainly will have a different regulatory environment in terms of privacy, similar to what I think they have in Europe now. And there will be some impact from that, I'm sure.
Yeah.
There's not a lot of history of successfully breaking up big monopolies. If you look at all that Microsoft went to, go back to AT&T. Now it's all put back together, basically. And some would argue that some of those businesses actually, it would highlight value, and they could be worth more. So we're not really predicting a world where that has a lot of momentum. But again, not to switch topics, if you get into a Warren Sanders presidency and a Democratic Senate, better off.
You've kept your team together for a very long period of time. Many of the average, I think, of your senior people is around a decade. How have you done that?
And also, I do want to get back to 99. There's one part I didn't quite finish there. But I think it actually starts with how we hire. We go through a really, really extensive process because once we bring someone in, we want them to be part of Maverick for a long time. And there are different ways to skin a cat, but I think certain firms take the approach, we'll hire 6, and after a year or 2, we'll figure out which 2 of those 6 are the all-stars. And we have not done it that way. Secondly, I think we're full in our decision process, and yet the firm is big enough, they have all the resources they could ever want. And last and probably most importantly, it's, I think, a very healthy environment where we're all competitive, but working together as a team. We actually don't track an individual's P&L. We track the team's P&L, and we want that team to be successful.
And that team is made up of how many professionals? How many people would be on a team?
Our largest is about a dozen, our smallest is 3, so it's probably average is 4 or 5.
That's
Six.
quite different than a number of your peer firms, where you know your P&L by individual. And when you hire, you said, we don't hire 6 to have 2. What do? You hire what to have 2?
2 to 3.
2 to 3. That's interesting. That's interesting. If you wanted to go back to 1999.
So if we draw that parallel, it's 99. I didn't want to end there because I think many would walk away going, oh my gosh, he's predicting a big crash.
Yes.
Well, if you say it's like 99, it's really important to distinguish. Are we talking about the end of 99 or the beginning of 99? People forget, from the beginning of 99, the S&P went up another 26% through March of 2000, and the NASDAQ went up 131%. And if you look at what sort of undid 99, it was a Fed that was too aggressive, started raising rates summer of 99. They raised a final 50 basis points to get to 6.5% in May of 2000, after the market had already cracked. I think by contrast this time, the Fed's been very clear its intentions to be benign, and frankly, as we get closer and closer to November with the election around the corner, I think it's going to be challenging for the Fed to get aggressive in terms of raising rates. So I think, unlike 99, we have that benign Fed, and S&P yield is still 3% above Treasury yield, so there's some valuation support. So I'm not super bullish, but I think we're much closer to the beginning of 99 than the end.
Okay, that's a really important point. Some of you think about, who've been investing for a long time or are students of markets. If you think back to 99, that was a fundamental game-changing shift. And in general, when people talk about it, they talk about it, 99 was the point of a game change. You're saying it's the end of the year versus the beginning of the year. Beginning of the year still had a lot of runway to go, and you think you're closer to that than not.
That would be our educated guess.
And is there any parallel on, we were talking about the size of passive investments, passive market players, any parallel between the retail market of 99 and passive investors today?
I would say this in a way that's not, doesn't make me sound like a jerk. Retail investors are not very good investors, right? They're just not very informed investors. And so competing against them was pretty easy. And I would argue, to your point, passive investors are not really very educated investors.
So there is a parallel, you
I hope so.
That's good. If you look to what's going on in the market right now, beyond that we're toward the beginning part of 99, what do you see as being something that would concern you about this market? What would be the thing that would end this period of Goldilocks moment that we've talked about?
Yeah, so I think the word Goldilocks is apt because we're in this world where there's enough growth that people expect robust earnings, and yet so little growth, people expect really low rates. And that's a delicate balance. And so I think anything that would get you off that balance one side or the other, you could have, if we slow down, coronavirus becomes a much bigger issue as an example. You could have disappointing GDP and disappointing earnings. And if things really heat up, especially the Fed can't be in front of it because of the election, I could see by the end of the year, rates starting to creep up, and rates are what's supporting these pretty significant valuations by historical standards. So I think it could go wrong a couple different ways.
One of the things that a number of people were talking about in terms of changes is around climate and the amount of money that the world will have to spend on climate. Do you follow that? Do you prescribe to that? And would that be something where the amount of capital necessary would result in the kind of thing you're describing, which is the potential for an inflationary period, which would fundamentally shift this Goldilocks moment?
So personally, it's something we've, as a family, have been very focused on. It's an important issue for us. As an investor, for a long time, I argued our job is to maximize the returns on a risk-adjusted basis. We deliver our investors. I never told them, oh, by the way, I'm not going to own these kind of stocks, and that would be unfair to them. There's a growing body of research that stocks that screen well on different ESG concerns outperform over time. And now what's interesting is we've looked at that pretty deeply. it's really been true in the last few years. And I think it's not because the actual company is performing better because they're environmentally concerned or there's good governance. I think it's because so much money is going into the space. And so the stocks that screen well are getting more capital. Nevertheless, I think that will persist. And so actually, within our quant work, it's a factor that we are paying more and more attention to.
You're describing the amount of capital flowing in, and you're describing the social contract you have with from a family point of view or an investment point of view. Just to come back to that one more time, the amount of money that may be necessary by governments to spend on this issue, do you think that issue will shift or break or could break this Goldilocks moment that you're talking about?
Not in the time horizon I'm talking about, which is a year or two. But I do think the flow of invested capital, I'm thinking about passive active. I think we're going to have something very similar because it's every superannuation fund in Australia, which are the biggest pools of capital. It's increasingly every single university. It's all the pensions, and especially in Europe. But I just think increasingly companies are going to be forced to be more ESG focused because they're going to recognize that the role that's playing in their own valuations. And I do think that will be a benefit.
You know, during your career, this has been such a great business. You know, you get to learn a lot about a lot of industries. You work with terrific people. You have an opportunity to make important decisions. If you had a young person today, and obviously you have family, but if you just look at in the world of business today, if someone wanted to go into finance today and be a financial investor, would you recommend the long-short business?
I think it depends on the person. I mean, just to back up, as my son and I have had a few of these discussions over the last few years as he's entered the workforce. My advice was find your passion. You know, what is it going to be when you wake up in the morning, you can't wait to go to work? And by the way, if you work with people who also have that passion, you're probably more likely to make good friends, et cetera, et cetera. And we meet people all the time in our process who picking stocks is their dream, like it was for me when I was that age. And so if that's your real passion, absolutely go for it. But as a business, it's a far, far more competitive business today. And I think that will become more true year in, year out.
I'm going to open it up to the floor in 1 minute. I'll ask one last question and then back to you. We'll spend about 15 more minutes or so on this, and then please join us for a cocktail. Lee, when you look at what's going on in society today, there's a whole pitch around the inequality of society is resulting in social tensions around the world. What should, if you believe that, what do you think the world of finance should do about that, if anything?
I'm not sure the world of finance is going to provide a meaningful solution. I really do fear that, we call Tom Brokaw's generation the greatest generation. I think our generation may go down as a generation of greed. To be operating with a 5% budget deficit with a robust economy and full employment, we're already $70,000 per man, woman, and child in debt, and we're growing that by $3,000 to $4,000 a year. What we've done to the environment. And so I personally have not heard of a thoughtful tweak to financial markets which would drive better incentives. I do think we'll be facing higher taxes, and necessarily so. I don't mind paying higher taxes. I'm very fortunate, but I do wonder if the government is a really effective wealth redistribution mechanism. So I hope there are better answers out there, but I'm unfortunately not sure I'm full of them.
So your view is we need to do certain things, but maybe government's not the best way to do it, I think. Is there another way to do it, or how?
I'm not sure there is another.
Not sure. Okay, we're going to open it up to the floor. And if you don't ask a question, I will definitely call on you. Yes, please. Please say your name if you don't mind and tell us who you are. Say it again. Alix, okay.
So most of the literature on portfolio management is terrible, except you've written to a best chapter.
Thank you.
How
You can stop there.
to this current market structure in terms of your gross exposures? Do you keep gross exposures still at the sector level and net exposures? Do you try to keep positive net exposures at the sector level?
Well, one of the things that's changed as we have evolved is recognizing that just because it's a technology stock doesn't mean it's going to respond like other technology stocks. And in the world of technology, how Alphabet versus a semiconductor manufacturer, and so we decided far more important to track industry exposure is factor exposure. What is our exposure to high growth stocks? What is our exposure to stocks that are heavily owned by their hedge funds? What is our exposure to beta, et cetera, et cetera? And it's all driven on a bottoms-up basis, but there are times we take a step back and look at our exposure. It's outside our norms, and we'll go through a proactive evaluation of, gee, if we're more long growth than we typically are, is that a good thing? Is growth really cheap? Has growth underperformed? Yeah, maybe it's a good time to be more long growth than we typically are. But is growth really expensive? Has growth outperformed? Well, maybe it's not the right time to have too much exposure to growth. And then on the gross exposure, we've also become more sophisticated in looking at our expected volatility in different ways, and that plays a big role in how much gross we'll take on. We use that as a lever to control that expected volatility. And so to answer your question right now, we're slightly below our long-term average on net and slightly higher on gross. But on a beta-adjusted basis, we're actually meaningfully higher on net because there's a pro-cyclicality bent in the portfolio right now. Yes, Larry.
Sorry. Larry Sidley. Lee, just curious, what is your view right now of the divergence between, your view of the divergence between corporate CEO confidence and consumer confidence?
I think it's catching up. I think what Larry's referring to, we're going through a period of time for the last couple of years where consumer confidence has been consistently strong and CEO confidence lagged pretty meaningfully. And I think the CEOs were more focused on the number of different types of uncertainty from Brexit to China trade to the Fed to Trump in general. And I really think in the last few months from who we're really hearing it from more than anyone else are bankers who are starting to see deals that have been working on for a long time, people down being proactive and pursuing some of that. And I think if you look, we've had wins on a lot of things. So phase one is done. I don't know if there'll ever be a phase two, but that in itself is meaningful. NAFTA is done. Brexit is done. The Fed said, hey, we're not going to do much. What I thought could have been a scarier situation with Iran, although it was very tragic that plane was shot down at the end of the day, I think that really removed some of their options that would have been scary. So I think there is reason that the CEO confidence is picking back up, and I think you'll see that reflected in CapEx, in buybacks, and in M&A activity. Yes, in the back.
Go right ahead.
Thank you. Mark Giordano. So I think we could all agree that the next presidential election is consequential. How does do politics play into your investment thesis? And do you watch the polls in order to make certain prognostications about the likely outcome of an election in the context of your portfolio?
So I'll start with the end of the question, which is it really doesn't play a big role. Again, we expect our net exposure to be low enough that a good or bad market is not going to have a huge impact on what we're doing. Certainly that's not true for individual companies or certain sectors where there could be a regulatory impact. We tend to look at everything from the British betting books to Nate Silver's website and some of those tools, none of which were very helpful last time. I know probably the most successful macro investor of the last 5 years. He thinks if it becomes clear that the Democratic candidate will be either Sanders or Warren, that the market will respond very positively because there's no way either of them can be Trump. So how these things all play out is interesting. In the back?
In the last 13 years, a lot of hedge funds have closed, a lot of hedge funds have underperformed in a significant fashion their benchmarks. Is there a structural reason? I mean, I don't think hedge fund managers have become dumber. Is there a structural reason that you see day in, day out that has led to this underperformance and closing of hedge funds?
Well, hedge funds, both in terms of numbers and assets, grew steadily from the late 80s all the way up to 2007, and then the financial crisis hit, and that changed things. And I would argue the quality of the average hedge fund manager in 2007 was not very special. And they really weren't adding a great deal of alpha. So there's a reason a lot of those folks have faded away. Indeed, at the end of 2007, total fundamental long-short assets as a percentage of the S&P was 5%, and in the last year it's 3%. So relative to the market, there's been a 40% decline, which, by the way, means there's less competition, so that's nice. I think a lot of that capital became very short-term oriented and didn't really have the luxury of, I mean, at Maverick, half our capital has been invested over 10 years. We don't really, I don't like having a bad month, but it doesn't change how we do anything. And I do think there was a growing portion of capital that got very day-to-day focused, very short-term focused, and you often saw, I mean, if you look at the last four major pullbacks in the market since 2012, the average hedge funds caught 78% of that pullback. And so, this idea of reserve capital wasn't really pulling true, and to your point, in the strong up cycles, they were underperforming as well. And so as an industry, and I don't think it's all our fault, in this world, Sam Druckenmiller has this phrase, we have emergency monetary policy with no emergency. And so after 10 years of that, it dampens dispersion among stocks. So the gap between the best and worst performing stocks has become much smaller. It increases intra-stock correlation as they're all responding to macro factors and less to individual fundamentals. So those two circumstances had made alpha generation far, far more challenging. So again, I think the end result is probably good for the future of the industry, but it has not been a fun decade.
I guess you could argue that we have an emergency monetary policy and we have an emergency fiscal policy.
Yeah.
Right? So it's not just one, it's both.
Absolutely.
Actually, and no emergency. Yes?
I was Marshall Chappie. I'm intrigued by your comment that equated passive investors with retail investors 2 decades ago. I wonder if you see anything that could derail the movement to passive, including perhaps a more difficult market for risk assets, or if it's just inexorable.
So I personally believe we're going to be in a lower return world for a while. And as a result, the focus on lower fees is paramount. And so I think that will keep dollars flowing to passive. And I think the only thing that would really change that is called a 3-year period where the actively managed mutual funds significantly outperform. And there's no sign that's happening yet. But I think it would take something like that to really change those flows. Yes, in the back?
Hi, Art Steinmetz. Could you share a little bit more on your approach to so-called alternative data? There's a lot of alternative data vendors out there, and I suggest that the amount of alpha nuggets you can get out of it is inversely proportional to the availability of the data.
So since the person that runs that effort is sitting here, I have to say no. I'll give you a little more. Where I think we've had some success maybe more quickly than we would have guessed is because we're trying to take advantage of our fundamental knowledge and ask the same questions we've always asked as fundamental investors and just trying to answer them in a more comprehensive and consistent way, as opposed to here's a data set, Mr. Data Scientist, what can you find? Or machine learning, what can you find? Because if there's no economic logic behind those relationships, my confidence that they would persist would be quite small. But to give you a sense of the mindset, back in the 90s, we were hiring teams to go count cars in Home Depot parking lots. There was one website we used to scrape every night because we could tell what their sales were back in 2003. A lot of companies over time will order from that company once a week to get the invoice number, because then we could track how many invoices had happened in that past week, and we knew the average size of it. So I can go on consumer surveys. These are all things we've been doing for 20-some years. But in hindsight, now I recognize they were so anecdotal, they were so inconsistent. Today, we can ask those same kind of questions of a data set, build a model, statistically test that model, and so our confidence in those insights are much higher. And just one last comment, which I don't think will get me in trouble. I think people hear this, and the most common conclusion is, oh, they're buying credit card data, building a model, what percentage of that company's sales come from credit cards, I can predict revenues, what does the street think for revenues, I'll be long or short. That worked for about a year, and that ended 4 or 5 years ago. I mean, that's just too easy. So what we're doing now covers every industry sector. In many cases, we're getting insight not just in top line, but more in the margin structure. A lot of these are data sets that, to your point, a lot of other people are using. Now, on average, by the way, those data sets are becoming cheaper because people are having less success extracting value than I would have thought. Also, a lot of data sets that very few people are using that may not be obvious what their applicability would be. Because in many cases, if I have on a scale of 1 to 10, this data set is a 6 and this data set is a 4, but if I can use them together in a pretty creative, thoughtful way, now it's an 8 or a 9. So again, we're several years into the effort, and having said that, I still feel like we're in the second inning. Yes, in the corner?
Can you talk for a moment just about your views of private equity and its impact on public capital markets and its effect on what's happening to the long-short business, if it is impacting the
In front
long-short business?
in front of Marie Jose, really?
You can do like
I guess I'm jealous. It's just amazing how much capital gets raised. I think, and I sit on several different investment committees. If anything, I think the trend is higher allocations to private equity. And the part that I find frustrating, a big driver of that is, gosh, there's so little volatility. These have been not only been very, generate great returns, they've done so in a very steady manner. And I'm sitting there thinking, no. They're all long. There's no hedge at all. And by the way, it's all levered. These are levered long returns. And just because the marks don't get taken day in and day out like a public equity doesn't mean this is a less risky asset class. But again, I wish I had that issue. But I do think it's going to be more challenging going forward just because if you go back just a decade ago, it was so easy in a lot of cases to create value just through structuring the balance sheet more efficiently. A lot of those opportunities are gone. In a lower growth world, I would argue most corporates are looking to grow through acquisition, and they should have, in most cases, an advantage over PE because of the synergies that they can realize. So that makes it more challenging. But again, I think the next decade is going to be lower return for virtually every asset class. Yes?
Hi, Bill Pearlstein. On private equity, all of us who shop at Fairway can be really unhappy with private equity this week. My question is, both you and Mark referred to the 5% deficit, the $1 trillion. It's not sustainable. How does that affect how you're thinking about your investments on the long term? We don't know when the break will be, but at some point, the markets are simply not going to keep absorbing $1 trillion of U.S. debt with no consequence.
Well, it's actually only 4.7%, if that makes you feel any better. I don't really know the answer. I do think if, say, a Mike Bloomberg were to become president, I think he would be serious about addressing that issue, and I think that would be challenging for the markets. But at some point in time, we are going to have to eat our medicine. And again, if it's 20 years from now and I'm gone, I think it's one of the reasons our whole generation will not be viewed on in a very positive manner by the younger generation. But it is clearly unsustainable when you think, well, gee, what does that number do if things do slow down? Or what does that interest rate payment look like if rates do go up? It's scary. And I'm amazed it's just kind of fallen away from the political discourse.
It will fall away until the parties change. And then the party currently in power will rediscover the issue and block it. That's what I project. The deficit coming into this administration was going toward $500 billion. It's now just over $1 trillion. It'll fall away until someone allows themselves to say, the deficits matter, and that's likely to be when political power at the top changes, which isn't a good moment because then if you go into a recession and you need it, you have a problem, which is why I think it's both a monetary and a fiscal issue right now. Okay. Anything else from the floor? Yes?
Henry O'Connor, you had said at the beginning of your talk that you look at risk and evaluate risk very differently than you did 10 years ago. Could you elaborate on that and perhaps give an example?
Well, a little bit was mentioned earlier. If you go back 10 years ago, I'll give you a couple examples. We were primarily thinking about our exposures by industry and by geography, and now we're much more focused on factors. When we went through '08, we did better than a lot of hedge funds, but still was the first time we'd ever had a loss in a year, and it was very painful. And I remember thinking, this is a once-in-a-lifetime event that I'll tell my grandkids about one day. Then just 3 years later, in the Treasury downgrade in August of 2011, it wasn't the same magnitude. It was a very similar impact in our portfolio, not in terms of the numbers, but in terms of how stocks reacted. And it was very clearly another risk reduction by the hedge fund industry. So all the best longs got sold and all the best shorts got covered, and our alpha was very negative. In a falling market, it was very painful. And that to me was the recognition, I guess that's not a once-in-a-lifetime event. And if we're going to do better in the future, we need to develop systems to help us recognize the odds of this happening and help us reposition the portfolio. And the guy sitting in the front row, Riyad Abrahams, was given the task of trying to develop that early warning system, is how we referred to it back then. And it has a lot to do with understanding those factor exposures. It has a lot to do with understanding how other hedge funds are positioned, both in terms of factor positioning, exposures. We spend a lot of time measuring risk appetite across different asset classes to try to predict when that's gotten to a level that's pretty peaky. And I would say, fortunately, we've done quite well in market pullbacks ever since, but I'm not attuned. The other part of this really proud was spent a lot of time essentially trying to predict GDP in real time, so build our own internal economic activity indices. And that gives us a picture that has helped us make some good decisions at important times.
Last question. Yes.
What's your, not to give away your secret sauce, but what is in your synthetic GDP index that's not in the one that comes out from the BEA? If you could share that.
I missed that.
You mentioned that you come up with your own index or sort of GDP calculation.
Right.
If you could tell us the secret sauce, that would be great, but give us a broad idea.
I don't think there's any secret sauce. It's more just going through the whole process. I mean, we're collecting virtually every data point that we can think of that relates to the health of an industry or the economy that's released at least weekly or at least monthly. And they've just run massive regression analyses. In the US, it's very, very accurate. China, much less accurate. Europe's pretty good. And again, we're not driving big decisions about exposure, et cetera, but we do use that as part of the framework to try to understand where we need to rethink our positioning.
Lee, thank you very much.
Thank you, Mark. Appreciate it. Thank you, Mirza.
Thank you, Lee. Thank you for your candor and your insights, and thank everyone for your questions. I think it was a very good discussion. And I'd just like to remind everyone that we have quite a rich program going forward. We have Ken Griffin, who's later this week. We have Dr. Tarbert from the Commodities Future Trading Commission on February 10th. Ambassador Douglas Silman, who was the president of the Arab Gulf States Institute in Washington and the former U.S. ambassador to Iraq. So that should be a very timely discussion. And then we have a real estate investment panel on March 14th with Steve Roth, Bill Rudin, and Lisa Picard. And then we have, of course, on March 11th, our Women in Business Symposium, and I hope as many of you will attend this. It's not limited to women business executives. And David Solomon, on April 2nd, and Anna Winter on April 6th. So I hope as many of you as possible will attend as many of these events. Please enjoy the drink. The bar is open. And again, thank you, Mark, for leading such a healthy discussion, and thank you, Lee, for sharing with us your thoughts and ideas. So thank you.